time, it's becoming quite evident that the token world is very much a casino. There's 40 million tokens out there. Back when Lisk launched in 2016, there was only 3,000 tokens. So the market has changed a hell of a lot.
All right. Good morning, afternoon, or evening, all. Thanks for joining us today for Stable Stories. Today we have Gideon Greaves, and he is the managing partner of Lisk Ventures. Lisk, the blockchain, is a layer 2 blockchain dedicated to bringing Web3 adoption in emerging markets back to Ethereum. Gideon, thanks so much for coming. How you doing?
Dave, I'm doing well. Thanks so much for having me. Excited for the show.
Yeah, of course. I am too. First off, tell us a little bit about yourself. Background in crypto. How did you get started? And how did you come to Lisk Ventures?
Yeah, cool. So I'll skip to the good bit. When I was in my early 20s, I started a company in food tech. Thought I was going to take over the world. Read too many Steve Jobs biographies and similar. Thought I was going to raise money and do amazing things. And obviously, Africa at the time, me being from South Africa, didn't have a very advanced venture capital ecosystem. So I did pitch to a couple of private equity firms, VCs, never raised capital. Had to sell my car, bootstrapped. Got to the point where the company was doing fairly well, and we found product market fit. And then eventually got private equity funding from a company called Acorn, and then sold it to a company called Montague. At the same time, I think it was 2017, it was, at the gym, and this guy told me about Bitcoin. And to be honest, I didn't know anything about the technology at the time, but I knew that it had this very strong narrative of sticking it to the man, pushing back against the status quo sort of thing. Yeah. And that was enough for me to go down the rabbit hole. We started looking at how this technology can transform industries. And there were so many different theories of what this technology can do at that time. Fast forward to what happened a couple of years later is the focus became mainly on the speculative side of the crypto economy and less on the real use cases and utility that everyone spoke about. I think because many things, but one of them is it's not a very tangible technology. It's very much infrastructure based. Where AI is very tangible, you can see the value immediately. If you give your cell phone to your grandmother and she looks at ChatGPT and she starts typing and asks it a question and it gives back information on a recipe or something layman, you can immediately see the value of AI, and your brain can start wandering on different use cases immediately. Blockchain, obviously very different. So the people that adopted it first were the super tech savvy guys, which means UX, UI was very clunky. And then people that also wanted to take advantage of being able to sell a narrative to token and get early liquidity. Now things are changing, which is super exciting. There's more institutional adoption. We're starting to see real use cases come to fruition. At the same time, it's becoming quite evident that the token world is very much a casino. There's 40 million tokens out there. Back when Lisk launched in 2016, there was only 3,000 tokens. So the market has changed a hell of a lot. Going back to my story, after I sold my business, I went into venture capital. I find it fascinating to just be on the other side of the curtain and to invest in different founders, and having some knowledge from blockchain, just from deep diving it and owning Bitcoin. Got the opportunity to launch Africa's first Web3 fund. So it was a $20 million fund that invested in startups that utilize blockchain in Africa. And that took my career path in a certain way. Fast forward to today, I'm now the managing partner of Lisk. You gave Lisk a good introduction, but they're an OG, been around since 2016. Not that we want to use the token price or market cap as a measuring stick, but at one point they were top 5 in the world in terms of market cap. $7 billion was the all-time high. And of course, now the business has changed so much, right, in terms of just how blockchains and layer 2s work. So many of them, it's very much commoditized now. So at the same time, then Lisk decided to focus really on going where the developer ecosystem is. So we originally started as a JavaScript layer 1, pivoted then to a layer 2 within the super chain on Optimism to focus more on where we believe the best developers are, which is Ethereum. So we're EVM chain. And at the same time, we wanted to focus on the true use cases where the real utility is, and where blockchain can transform legacy industries. And we felt that was in emerging markets. And we felt that developed markets focus more on the, as I said earlier, more on like the speculative side of crypto. it's almost like a bonus, having blockchain in a developed market, where in an emerging market, it's a necessity. It solves very pertinent problems. Is it a technology upgrade that will be adopted globally? For sure. But the idea is that in emerging markets, it will just be adopted a lot quicker because it's solving a problem immediately. Where if you're putting title deeds on chain in Switzerland or Japan, it doesn't really solve a problem. But in Nigeria, 60% of court cases are attributed to land disputes. So putting property on chain to verify the true ownership of that is a use case that gets adopted immediately because it's a super big problem there, right? So yeah, that gives you a quick rundown on how I got into the industry and how I got to Lisk.
You covered like a million things that I want to double click into there. Excellent introduction to Bitcoin. I was similarly compelled by the idea of sticking it to the man initially, and now find myself about 7 years into the industry. I remember Lisk in the early years as well. I've been around for a while, but yeah, it's interesting how the roles change and the industry changes. One of the first things that I really want to like ask you a little more about is the nature of the crypto industry early on. This is sort of it defaulted to either highly technical or sort of speculative use cases. And, I've been thinking a lot about the last 5 years and the sort of self-referential games that we've been playing internally, and how that's transitioning out into the broader market and how the industry changes as a function of that. And I'm wondering what you think about the evolution of the space itself. Like, is the fact that it was highly self-referential, highly internal for so much time in parallel to something like the development of AI, right? A function of the tech just not being there yet, or the inability to build the consumer face, or the inability or the unwillingness to build the consumer facing front end. So I guess the question is, like, if we brought in the best product designers in the world 5 years ago and slapped it on top of the technology that we had, would the technology have been sufficiently robust or efficient enough to make it usable, even with fancy and shiny buttons to click? Do you know what I mean? Like, if you could put it in front of grandma, would the tech have been there at that time? And is that why we ended up in that spot, or is there some other reason? That was a long question. I apologize.
No, it's a loaded one, right? So it's difficult to unpack. So I can give you a disjointed answer of a few things. I mean, one, I think when crypto assets launched and became popular, it came at the same time that you could access the stock market whilst lying in bed on your phone, not knowing anything about it, and clicking 3 buttons, and now you own Tesla. Where before it was very difficult, very clunky, and it took a long time, and no one even bothered. But now you had 16-year-old girls buying stocks in GameStop and BlackBerry, where they never even used to do that. And that happened at the same time where the crypto assets exploded and also allowed for early liquidity and leveraging dumb money. And I say that lightly for lack of a better word, but the usual route to market for any product or startup to a liquidity event is starting a business, bootstrapping, getting some traction, being able to sell a story to an investor, raising capital, and using that to grow. And along that journey, there's still the likelihood of failure. I mean, you have to hire, fire, pivot, persevere, raise more capital, then pivot the product again. And then eventually in 10, 15 years, there's an IPO or there's an acquisition or some secondary market event where you can finally take some money off the table and you feel like it was all worth it. Where crypto just threw that on its head because the investors that participated were not savvy professional investors. So they were investing on the basis of a narrative, a story, vanity metrics, i.e. how many Twitter followers does the project have, and this promise of the changing a new world, right? So we had all these projects with white papers and cool websites and other followers in their Twitter account. And then these guys that launched these different projects over time, some of them intentionally were scams, some of them, of course, were not. But if you think about the psyche of some of these founders, they're making millions of dollars in months. So that reward at the end of a long journey, that exit that a lot of founders strive towards, that carrot is no longer there because you're getting rewarded too early. So they often will leave the business and try and employ a CEO, or it just no longer becomes worth it to actually build the product. And then obviously a lot of people started leveraging off of that, and VCs became part of it as well. Even though they knew the game was rigged, you can make, instead of 3x in 10 years, you can make 20x in 6 months. The liquidity comes quicker, the returns are bigger, but you knew it was a bubble ready to burst, right? There was no real utility there. Of course, I'm generalizing, but for the most part, there wasn't. And then the second part is more to what you were saying, I think, is that the early adopters were the tech savvy guys. So it was the Steve Wozniaks of this world. And that means the UX and the UI and the use cases that were thought of were either like theorized for what might happen in 10 years' time. So it was just too futuristic. All the way that any user interacted with it was very clunky. So I'm talking about consumer apps here, of course, like from an infrastructure perspective. The chains were there to build on, but there wasn't a lot of apps, building on these networks. So I think because it was very tech savvy population that adopted this first, but these products weren't really interacted with just because the skill set of these guys is more to understand tech. Again, of course, I'm generalizing, but what you're seeing now with the market maturing is you have sort of like the Steve Jobs of this world partnering up with the Wozniaks, and now these products are becoming a lot more easier to interact with, simpler to understand. And I think what's super important to know is that blockchain is becoming more and more and more and more in the background. And I don't think you'll get any more Web3 funds in the future because blockchain will just be the standard infrastructure technology across most different markets, certainly financial ones, but most markets. So a tech fund, a fund with a tech mandate will end up investing in blockchain anyway. So I don't think you'll get these dedicated Web3 funds. So in the previous fund that I launched, which is still running now, we invested only equity. So Lisk is the same, even though we have a token and we're a protocol ourselves, we only invest in equity just because we haven't seen anything good with a token that makes sense. So I know that was a bit of a disjointed answer, but I hope it gives you some color there.
No, that was great. And the idea of blockchain sort of like disappearing into the infrastructure layer makes a lot of sense. I think about, there's a great quote that I'm going to butcher by Alan Watts. It goes something along the lines of like, when your eye is working, you don't notice your eye. You only notice the things that aren't working properly. And I think a lot about blockchain and stablecoins, more specifically, the end state being something that fades away into a neutral background and just works and makes the organism at large better and more efficient. Definitely. One of the other things from your intro that you mentioned is you have experience on both sides of the coin in terms of the founder VC relationship, both acting as a founder and later on as a VC. Maybe you could talk to me a little bit about your experience as a founder trying to raise an emerging market and some of the challenges you faced there, and maybe how that informed you moving into the VC space and also focusing on emerging markets with Lisk.
Yeah, I mean, it was super difficult. It is easier now, right? So I'm speaking of a different time, but there's still similarities. The VC ecosystem in emerging markets is still lacking. It primarily just fills seed stage. As soon as you start raising Series A rounds, you have to look outside the continent or outside your country, whether you're in Argentina, Vietnam, or Kenya. So I think it was very difficult at that time. Like the capital that was around didn't understand VC economics. So every time you did get an offer of someone to participate in a round or invest in the company, they would take way too much equity because they were thinking about it from a private equity perspective and can they get a good deal? But in hindsight, that kills the cap table and you can never raise meaningful money from any professional investors later on because the management and founders just don't earn enough of it. So I think the main thing that I realized at the time was that the venture capital ecosystem is very immature, which means that, of course, there was still capital around, but it means that you have to bootstrap much longer and show traction much more than, my US counterpart, for example. And that still exists today. And I think that presents a massive opportunity for investors in emerging markets because there's this valuation arbitrage opportunity. We just invested in an insane payments company in Kenya. I'm super excited about what they're doing. They're basically facilitating payments for freelancers and gig workers working in Africa, invoicing out of the country that would go through very archaic systems to receive their remuneration, losing 20, 30% just through the traditional finance rails. And now they're they're receiving their payments instantly at a fraction of the cost, right? So they, just to give you an example, just to give you some stats on how they're doing, it's a good case study for my point. In October, they did $500,000 in payment volume, the startup in Kenya. In November, they did $850,000 in payment volume. In December, they did $1.6 million. And I messaged him today, actually, and he said so far on this month, they're on $2 million. And I actually met him in February last year. And because he had month-on-month growth, but it was at such a low base. I said, let's see how you do next month. Let's see how you do next month. And he's just shooting the lights out. And now he's got B2B, B2C. I mean, he's just smoking it. Anyway, long story short, we invested in that company at a $3.3 million valuation. We invested $100K. He raised a $350K round. But point is, anything remotely similar to that with those sort of economics and metrics, in the US or developed market would be raising at a $30-40 million valuation. And that's also caused venture as an asset class to hugely underperform, specifically in the US. And there was a study that came out recently from Cambridge Associates that showed that the average IRR, or yearly return, from VCs in the US over the last 3 years is on average just under -3%. So LPs and investors don't want to deploy into venture capital funds in the US right now. And why would they? You could invest in gold in the S&P 500, where it's completely liquid. You're not locked for 10 years, and you're performing better. So my thesis is that all of the new technology that we're seeing, the likes of AI and specifically Web3, because how transformative it can be in financial infrastructure, is that it's going to disrupt the huge problems that we have in emerging markets. I keep on using the example of Africa, of course, being based here myself, but we have a huge unbanked population, and I'm sure a lot of your listeners know about, or can at least imagine about the banking and financial infrastructure issues that we have, and Web3 will solve these problems. And it comes at the same time where there is already capital flowing into these markets. There's a cool statistic that we developed from pulling different data sources from the three areas that we focus on mainly, which is Southeast Asia, Latin America, and Africa. And it shows that between those three regions, in 2015, there were only 2 unicorns. And since then, until the end of 2024, there's now 74 extra unicorns, a total of 76 unicorns. So we are seeing a ton of growth. And my personal thesis is that these investors in the US, etc., for them to start seeing outsized returns again, are going to have to turn towards emerging markets and start looking at deploying capital there where the valuations are rational and there's huge upside for growth. So seeing all of this, being a founder, also wanting to participate in helping people reach their dreams sounds cliche, but it is an awesome feeling when someone says, I'm giving you 100K when you sold your car. It's a great feeling. So it's really cool to see and engage with many people, that we have at Lisk, and helping them, fulfill their different use cases and their visions of how they feel they can disrupt the market.
Definitely. In your mind, why does this arbitrage exist? Because the way you lay it out, it seems like a no-brainer, and you would assume that efficient markets, the arbitrage would close over a relatively short period of time. But why do you think it persists right now?
Yeah, so it's more obvious in Africa, by the way, for sure, than in Southeast Asia and Latin America. Since I've been at Lisk now for a year, we're seeing deal flow from all of these regions. It's more obvious in Africa, and I think that's like from a trust standpoint, geopolitics, regulation, not understanding the market. I think a lot of people are skeptical to deploy capital there. I mean, fundamentally, it's lack of capital that's creating that arbitrage opportunity. But now I think with globalization, people are starting to understand the use cases in Africa. Africans are also understanding on how to sell their story better and how to set up themselves compliantly to appeal to a US investor. For example, setting up their holding company in Delaware or the UK or Singapore or whatever it may be. So I think that is definitely going to change. And I think being an LP in an emerging market is definitely the way to go right now, for sure. As you said, the arbitrage opportunity is super obvious, and it will close. So as Warren Buffett always said, you want to invest when everyone's fearful and sell when everyone's greedy. And I think in the US, they're pretty greedy right now.
Fair enough. Yeah, that makes sense. One of the other things I'd love your take on is the idea of sort of blockchain and Web3 as a nice to have versus a critical infrastructure, and the disconnect between that. And the role it plays in the overall adoption in different parts of the world, emerging versus developed markets. What seems to be the general consensus emerging in developed markets is the majority of stablecoin flows, at least over the next 12, 24 months, is going to be primarily large institutions, moving size across borders, between institutions, treasury management, things like that. Whereas the retail adoption end, even though there's an emergence of neobanks, is still a big question mark. Whereas in developing markets, payments, P2P, was the original use case, right? Not use case, but one of the original modes of using stablecoins. And that was way, way, way earlier than we saw anything in developed markets. So like the incentive to adopt and to innovate as a function of either geopolitical or financial necessity domestically seems to be a massive spur to that development. And I wonder if you talk about that disconnect in the different adoption paths in the two markets.
Yeah, so I think The main, just to summarize it, I think the main use cases that we're going to see from Web3 is certification, verification, and the change of money systems. But where I think we are in that life cycle now is in payments and money. I don't think we are going to see a lot of verification use cases yet. For example, verifying ingredients in drugs or pharmaceuticals or supply chain. Yes, we are starting to see it. There is adoption there. It's not like no one is using these products. But I think where the focus is now from an institution Wall Street perspective is on money systems, and the attraction there is payments and, like you said, stable coins. But I think in Africa, it's super attractive and it hasn't been unlocked yet. There's, I think, literally only one stablecoin that's doing any meaningful volume or has any meaningful float, which is still tiny. Obviously, the focus has been on Tether and Circle and having a UF stablecoin. So all the new ones that have subsequently launched have been trying to compete with that and list on exchanges as the main use case for liquidity. But now it's changing to real world use cases. And I think stablecoins are very much going to start becoming in the background. And any person or founder or company that is starting to launch a infrastructure business in stablecoins, I think sometimes people make the mistake of integrating with everything and focusing on too many fintech partners to get volume and to build their float or TVL. But what they need to do, I think, is focus on where money already flows and just quietly come in there and put everything on chain. Super hard to do, of course, because of regulation and bureaucracy in these massive corporations. I'm going to get the stat wrong maybe slightly here, but it's between 1.4 $1.7 trillion of mobile money was moved last year. And that's the core sort of currency in Africa. And 2/3 of that was from Africa, and the natural progression of mobile money is going to become stable coins, right? A lot of these payment providers make their money from the float and how long they're holding it there so that they can generate interest on that. I mean, that's Tether's whole business model, basically. Because the duration is so much longer with the stablecoin, you can earn so much more. So I think you're going to see a lot of payment providers or rather stablecoin issuers going to the likes of Airtel Money and M-Pesa and convincing them to utilize their stablecoin infrastructure and then share the float. I don't think we'll see them launching their own coins. There's just too much bureaucracy and regulatory risk for them to do that. But I do see someone in emerging market adopting stablecoins as their core payment infrastructure really, really soon. We've seen that work globally as well, right? I think the next part of where it becomes super useful, and then I can speak more to the use cases in Africa or other emerging markets and why blockchain is a better technology for the continents like South America, etc. But is going to be tokenization, but it's going to be tokenization of financial products. And we're already seeing that with what Securitize is doing. They're about to list at a multi-billion-dollar IPO. We're seeing the likes of BlackRock and KKR and Hamilton Lane having tokenized their products. So I see tokenization of financial products and payments as the main trend for next year, or for this year rather, 2026. And then I think there will be more use cases that come on the back of that. But going back to what we've seen historically, developed markets have always focused on speculation, so on trading and some of the different DeFi use cases. And emerging markets have always tried to use it for payments and to move money and for verification. So we invested in in a startup called House Africa that verifies property on chain. I made that example a little bit earlier in the podcast. I think another very obvious use case that I think we're going to see soon, well, I hope we're going to see this soon, is governments being on chain. And this is going to come primarily from competing parties using this narrative as part of their campaign and hopefully actually pulling through with that promise. Huge amounts of the GDP in emerging markets is lost to fraudulent activity, which is mainly due to poor tender and procurement processes from government. So if that was completely transparent, these markets will completely change. And with AI coming in at the same time, auditors are going to understand exactly where this money is going very, very quickly, especially if it's on chain.
Bringing governments on chain sounds like a nightmare for every politician that I can think of. But I mean, as an incentive, if the other party's doing it, the impetus to do it yourself.
I don't think any government is just going to adopt it because they want to be
proactively.
I think someone is going to go, the only way I'm going to win is by doing something really bold. I'll figure it out later and make that as part of the campaign. So I think that would be how it starts to get adopted.
Have you seen any indication of any political party or actor that's made overtures at that? Because that would be really, really interesting to watch the development of. I could see El Salvador being one of the first to implement.
Dave, my son has just walked in here, so you may hear some background. But
He can say hi if he wants.
I haven't seen. So I mean, Trump brushed on it, but I didn't see anything material happen, and I haven't seen it. No, I mean I've
Okay,
seen some like articles mentioned here and there, but anything material where I see something real happening, not yet. But I'm sure it's coming. I think step
definitely.
one is going to be tokenization, and money systems changing, and then step two, I think we'll start seeing all the verification stuff.
And then we get to vote on the blockchain, and we're essentially a big DAO, which is very interesting. Cool. One of the last things that I wanted to mention, because you had brought up industrial application of blockchain, Lisk is doing something interesting with the ScaleX Global Accelerator, being led by the UN Industrial Development Organization. Just announced it recently. Wanted to learn a little bit more about that program, the idea behind it, because you're bringing in the idea of a public-private NGO partnership to actually foster Web3 innovation is really interesting to me. If you give me a little rundown of that program, that'd be great.
Yeah, so of course, the UN is a beast, right? So obviously, it's taken a bit of time to get this going, and it will launch in the first half of this year. But the agreement is done, the partnership is concluded, and which is very exciting. From the UN standpoint, and specifically the agency within the UN being UNIDO, like you mentioned, they have funded so many different initiatives with their different partners, and they realize, and it's usually to do with innovation in some way, shape, or form, and that tends to come from entrepreneurs, founders, and startups. And what they realize is that the technology that they're engaging with, to actually get real adoption, there needs to be some sort of distribution channel to enterprise. So the core premise of this program is going to be a lot of value add from UNIDO in terms of running through some sort of curriculum, of course, like you would in any program. I think that goes without saying. But the secret sauce to this is number one, it's of course the stamp of credibility from the UN attached to any of these founders or startups that enter the program. And then more importantly, the distribution channel. There'll be multiple corporate partners that will be part of these programs that the founders that go through the program or in the cohort can leverage off of, can utilize these corporations or enterprises as a test bed scenario or to pilot a project. And of course, as we know, 0 to 1 is always going to be from distribution. How do you get to customers? And if your first customer or distribution partner can be a large enterprise where you're solving a problem for them, that's going to make the world of a difference. And most of the time, a lot of these enterprises are skeptical from all these high-tech new solutions. So by the UN saying, we've got this program that we're partnering on with Lisk, come and check it out. So they're obviously there's a lot more credibility and trust there to go and take it more seriously and partner up with these different founders and startups.
Very cool. Awesome. Gideon, we're at about a half hour. I want to thank you. It's been a great interview. Pleasure meeting you. If people want to learn more about Lisk, where should they go? We'll add the links to the show notes at the bottom, but how do they find you?
Yeah, so there's a lot of exciting things happening at Lisk as well. As I mentioned, we started off as a blockchain. We understand the space and how much it's changed. So there's a really exciting product that we're working on in stealth mode that will be announced in the next 2 months. So keep an eye out for that. It's, I think, a lot more exciting than what people think. So we're spending a lot of energy and time building that. And of course, website and Twitter or X are the two places to go. Luckily, handles and website is exactly what our name is. So at Lisk on X and lisk.com on the website.
Fantastic. Enjoy the rest of your week. Thanks again, Gideon. Everybody, thanks for joining us, Table Stories. Have a good day.
Thanks, Josh.